Singapore's economy grew at a slightly faster pace in the June quarter, but growth was lower than the advanced estimates out last month. The economic headwinds in the coming months have also led to the government to lower the full year growth forecast for 2023. GDP growth for the April to June quarter came in at 0.5% on year. That is lower than the flash estimate of 0.7% for the quarter and missing market expectations for a 0.8% growth. The manufacturing sector continues to be the main drag on the economy. A slowdown in global demand for semiconductors has weighed on the city-state's manufacturing output and exports. Well, on quarter, the economy rebounded to positive territory, up 0.1% in the second quarter. It contracted by 0.4% in the first quarter. The Trade and Industry Ministry has lowered the official growth forecast for the year to a range of 0.5 to 1.5%. That is 1 percentage point lower at the upper end of the earlier forecast range. The government also said that Singapore's external demand outlook remains weak, and this comes on the back of subdued growth outlook in the advanced economies in the second half of the year. We'll get you the latest STI figures when trading begins, but now a quick look at the Sing dollar, somewhat flat against the greenback, 1.349 there. Let's bring in Alex Holmes, a senior economist at Oxford Economics, for more on those latest figures. Alex, let's talk those figures at a glance. What were some of the biggest drags? Of course, we know manufacturing continues to be one. What are some areas of concern for you?
Yeah, of course, the story of Singapore's economy is really a story of two different parts. So, as you mentioned, manufacturing is the biggest drag, and it has actually been a drag for over a year now, as export demand has softened globally. But the services side of the economy has actually been holding up pretty well. Domestically, we've got quite a tight labour market. People are still seeing relatively strong wage growth, and of course, tourism is coming back in a big way, and that's boosting us, particularly the accommodation and retail side of the economy.
Well, we know manufacturing is a big drag. Trade outlook remains poor. Is a rebound possible at all this year, subject to what conditions, of course?
Yeah, so really for growth to pick up again, you need for external demand to recover. And there are reasons to believe that that's not very likely. So other countries have tightened monetary policy very, very sharply, particularly the US. And we and most others, including the MTI, expect that impact is yet to come. So the outlook for global demand is likely to remain quite soft over the second half of this year and into 2024. And that means that a rebound in external focused manufacturing is probably not likely to happen anytime soon.
I'd also like to get your take on the MTI narrowing Singapore's growth forecast to 0.5% to 1.5%, down about 1 percentage point from its earlier forecast. What do you make of its latest moves?
I think it was actually only a matter of time before they were going to downgrade the target or narrow the band, rather. Getting to 1.5% growth even now would be a very tall task. And even hitting the bottom of that range, 0.5%, would require quite an acceleration in growth over the second half of this year. So our forecasts are actually that we'll miss that point and settle somewhere between 0 and 0.5.
Well, Alex, we know, you talked about a rebound being unlikely as long as global demand remains weak. And that is something we're going to be seeing in the US, in the Eurozone as well, especially the high interest rate environment. But with the Fed, possibly, stepping back from its hikes, I mean, could that offer some hope to economic growth in Singapore? As in the impact from how things fare in the US?
Yeah, the thing about monetary policy is it acts with a lag, so it takes time to feed through to the economy. So even if the Fed were to start cutting rates today, the impact would probably not be felt for a few quarters. And in fact, with inflation a little bit sticky in the US, there were CPI figures out recently. Um, it doesn't look likely that the Fed will start cutting rates until at least 2020, early 2024. So there's not really any prospect of an early relief for the global economy just yet. Of course, China, people had hoped that a big rebound in its economy would offset some of the weakness elsewhere, but its rebound seems to be fast petering out. There may be a little bit more impetus over the second half of the year as stimulus comes in, but probably not enough to offset the weakness elsewhere.
Mm. So we're still seeing sputtering growth from China, but we do see some more resilient economies in Asia, Malaysia, Indonesia, Thailand, for example. Do you think that is enough to negate the weaker demand from China?
Well, one thing that's really been helping recently is tourism flows. So there's still a lot of pent up demand in Asia for travel and from elsewhere. That's because Asia opened up a lot later than elsewhere. So visitor arrivals from the rest of Southeast Asia and wider have been helping the Singapore economy. And the tourism sector has been doing well. Of course, you've got all of these large events coming up in the rest of this year and in 2024, CF1 and Taylor Swift and Coldplay concerts. That's going to help a little bit. But the thing is that Singapore's economy is very export focused, very goods exports focused. And unless that kind of turns a corner, soft growth is going to be here to stay for a while.
Well, Alex, appreciate you breaking down those numbers for us this morning. Alex Holmes, a senior economist at Oxford Economics.